Hi there, and welcome to today's episode of Wealth Bites. I'm Mo Showman from mywealthchoice.com.au. Today, I want to unpack something I hear all the time from tech professionals. I already have an accountant. You can't imagine how many times I hear this sentence. They think that what a financial plan look like is at the tax time there's strategy, but after just one session, they usually realize there are huge blind spots in just having an accountant. And it's not their fault. Most people assume that because they're paying someone at tax time, they've got the financial side of things sorted. And the reality is otherwise. So let me start by explaining the difference between an accountant and a financial planner. So an accountant, they do a great job, but they focus on the past. They look at what happened last year and lodge the paperwork. They're literally financial historians. They have nothing that they can do to change what already happened for your situation. I want you to think about this. When was the last time your accountant called you out of the blue and said, hey, I got a strategy that will save you tax and help you make more money this year and every year? I don't think any accountant does that because it's not really the job. It's not how their tasks are structured, and it's not how their industry works. Most accountants are reactive. And I hear all the time that accountants are being reactive. My clients are always complaining about that. They're good at what they do, but they're not thinking ahead about your goals or your bigger picture in 10 or 15 years. It's very hard for them to determine this. In contrast, financial planning is future focused. We look at how to reduce your tax over the next 5, 10, 20, and even 40 years. Not just last year, not just this year innovated lease that you think is going to save you. I help you make strategic decisions, informed decisions on timing, structures, investments, and also exit plans. So if you want to, for example, build a property portfolio, you're thinking of, okay, how will I hand this to my children? Is there tax involved? Yes, there is, if you don't have the right structure. And this is where financial planners come in. If your accountant is doing something, he's really a scorekeeper. I'm a financial planner. I'm your coach. I'm helping you to train, improve, protect yourself from risk, and win the game. Last week, I had a conversation with a client who had an accountant with a very, very good relationship for the last 13 years. And when we unpacked the situation and what was been happening in his situation, what could potentially change, things like, RSU timing, long-term goals, what they want to achieve, what the future looks like, all these questions was not asked by the accountant. And this was like a reality check for them. Is the accountant the only profession that I need? And the answer is no. You need to surround yourself with a team of professionals that can help you to achieve your goals. Now, let me talk about what's different about tech professionals. Tech professionals have a complexity of the way they receive income and the way they pay tax. So most of my clients have high income from multiple sources. So they have their salaries, they have their RSUs, they have bonuses, sometimes even they have side hustles or properties that they're getting them some income. And the thing is, all these incomes are under their name. So it's sitting in one bucket for you. And what this means is you're accumulating a lot of tax in one bracket, which is obviously the highest tax bracket. So on the surface, looking with an accountant looks great. You're doing your depreciation schedules, you're doing salary sacrifice, all these very common and known strategies for people with high income earners. But here is how it gets risky. So, for example, when you have RSUs, most of my clients initially before having the conversation, they think that selling RSUs means, more taxes. And the thing is, it could potentially mean more taxes, but not in every situation. And when you delay the outcome of selling those shares to do something else, you're actually setting yourself in an over-concentration trap. And over-concentration is when you have a lot of wealth tied up in one company stock, and it's just sitting there and it's impacting your wealth building. I know you might be in love with your company. Sometimes my clients decline to sell those shares, and I understand. But there are ways for us to keep those shares under a different structure that reduces your tax by 32%. So imagine instead of paying 47% tax, you're paying much less. And the difference, instead of going into the tax man, it's going to your wealth building strategies, making you more money without doing anything different, really. It's just the same thing. You're keeping the company shares that you love and you're paying less tax. How good is that, right? The other thing that, very common across tech professionals is tax bills ballooning from poor timing of sales or bonus income stacking. They're just, having a lot of tax to pay, especially when it comes to Division 293. And that's, the most common complaint from tech professionals. They're missing out on smart contributions, for example, along super. Super is the most tax favorable environment in Australia. No matter how smart you are, how complex your financial plan is, if you're not using your superannuation in different ways, you're missing out. So using superannuation in different ways could save you thousands in tax and grow your future wealth for you and your family. Another very common, things that come up from the surface is missing out on plans for leaving, optional or retiring early. Most of my clients want to retire by age 55 or 60. Not that they want to stop working completely, but they just want to pick up the jobs that they want to work on. Consultancy, guest speaking, traveling the world and working remotely, all these sort of things that they would like to do in the future. And they want to make sure that they have the option to do that. So it's different lifestyles. You need to ask yourself, what happens if you want out, in 5 years, 10 years, 15 years? Can you do it? Do you have the option? And this is a very valid question. So you must be wondering where the gap hurts. So here is what actually happens when you only rely on an accountant. You get a yearly tax bill and maybe a few deductions, but there's no plan. There's no conversation about how to optimize your RSUs, vesting schedules, or how to reduce your tax drag. No forecasting, no scenario planning, just here is your return, see you next year. And that's not ideally what you want to do. This usually means that you are collecting invoices for this laptop or that desk chair to claim a tax deduction because your tax bill is just too scary. The lack of strategic planning is costing you big time. One of my clients paid an unnecessary 6-figure tax bill over 5 years because RSUs were mismanaged, and actually he had a better outcome should he planned ahead before those 5 years. And another client didn't realize they were missing out on $47,000 in super top-ups just because their accountant didn't check the records, and the compounding impact of that is really massive. You're earning a high income, every decision has exponential consequences. It's not that you miss out, it's the compounding interest of missing out. The true cost of no plan isn't just tax, it's wasted opportunity, it's a delay, it's a burnout without a finish line. And you can add to it also that the volatile job market and your plans becomes hopes more than solid and concrete plans for the future. So why I'm talking about this? Because tech professionals have a very unique wealth profile. They have high income but variable cash flow. They have a lumpy RSU events. Sometimes also they engage in ESPPs. They have big tax events from their bonuses, promotions, and liquidity moments. So often there is dual income households also with complex structures. So you need a financial strategy. You need someone to help you understand your world, who knows the difference between ESPPs and RSUs, who understands how equity interacts with different distributions and super contributions, trust contributions, if any, tax deductions from investment properties. All this, when they put in one mix, is a very complex kind of structure. So if you want to plan to take a sabbatical, for example, or launch a new side gig, or take 6 months off to travel, you need a plan designed for that. You need a plan that talks to your goals. One of the illusions I usually see with my clients is that they think that they're covered. It's one of the biggest traps I see, to be honest. People think they are covered. They say, my accountant handles it. But handles what exactly? Can you put a list of things that the accountant is handling for you on the top of lodging your tax return? I don't think you'll have a long list. So they will be lodging your tax return, and this is not the same as managing your wealth. That's completely different strategy. They will not be saving you, a lot in deductions. They will be saving you a few bucks, very kind of template, very standard. And this is not the same as having a plan with intention that have the aim of reducing long-term tax exposure by hundreds of thousands of dollars for you and for your family. It's not only about you and your family as well. There is this false sense of security. But when I ask, what's your 5 years tax forecast? I usually don't get an answer. How are you exiting your RSU position? I don't have an answer. What's your early retirement plan look like? Even on paper, I don't get an answer. So most people just stare at me blankly. They don't have any idea of what's going on. They think that things are, going all right. But when we really have this kind of conversation, that some clients find it confrontational, it's just kind of a eye opener for them. It's a reality check, as they usually tell me. So that's the gap. And once you see it, you can't unsee it. You have to work on it. So now you might be asking, what's a real strategy looks like? So a real strategy for a tech professional means that there is a strategy that more than numbers. It's clarity and confidence. It's knowing how to turn this year's equity into a long-term wealth. It's how to time income and contribution to reduce tax. It's how to protect what you're building and make work optional on your terms if you want. It's also about transferring assets to your kids without triggering tax. You don't want to give them a tax burden, really. So that's what I do through my confident choice system. It's not a one size fits all plan, but a roadmap tailored to your life, your career, and your family goals. It's a strategy that evolves as you do. It's an ongoing machine that helps you to save on tax on the short, medium, and long term. So if there is one thing I want you to take away from this, it's that having an accountant isn't a financial strategy. It's compliance, it's record keeping, and for someone in your position earning well, managing complex income, it's just not enough. Real wealth building needs intention, needs forward planning, and it needs someone who gets the tech space and how to turn your peak earning years into long-term freedom that helps you. So if you've been relying on your accountant and wondering why things still feel fragmented or reactive, now you know why. If you want to see what proactive strategic advice looks like, let's map it out for you. You can book your financial clarity meeting with me. It's not really a sales call. It's just a working session where we will look at your numbers, your structure, your goals, and show you what's possible if and how I could help. If that's something you've been meaning to sort for a while, let's talk. You'll find my details down below in the comment section or in the description of the episode. Just reach out to mo@mywealthchoice.com.au. I'll be more than happy to help. Enjoy the rest of your day.